Earnings season continues with Starbucks under the spotlight. In today's episode, they had a massive double miss on their earnings, and in today's episode we are going to take a look at this company, which is down over 15% just after market open. They did release their earnings yesterday. We're going to analyze why has this company crashed. We're going to take a look at their earnings as well as see their latest investor presentation, and we want to find out, is this company severely undervalued? Should we be adding to this? As always, we're going to run them through the valuation model. We want to get to our own intrinsic value. What is our acceptable buy price, as well as looking at our investor margin of safety and see whether or not Wall Street do believe there is still upside with this company that has been hammered today as soon as the market has opened. Now, we are going to do our usual analysis of companies. We're going to look at their growth on their top line revenue as well as their bottom line net income. We want to see how healthy is this balance sheet, their total cash versus their total debt, as their debt levels have been a worry for quite some time. And importantly, we want to look at their dividend safety. Their dividend yield is now above 3%. Is it still looking to be safe, or is there a worry with their fading metrics that maybe they will lower this in the future? And as always, both insiders as well as institutions will be under the spotlight to see if we can see any movements in one particular direction, buying or selling. So let's jump straight off into the historical performance. Now, yes, they are down over 15% today, trading at $75. Over the last 12 months, they are now down 34.51%, and just year to date, a very, very poor performance, down 22%. We can see they're at a new 52-week low, and we have 2 buy ratings from both Wall Street analysts as well as Seeking Alpha. Now, if you've been a shareholder over the last 10 years, you would be up over 113%. In fact, if you're someone who reinvests those dividends, it would be slightly higher. Although we do know you are sitting some way away now from the all-time highs in July. We're talking nearly 3 years ago at $126. Now, let's take a look. This company does trade now for around a 19 PE, so it is lower than the S&P 500 of around 21. So in terms of their numbers on the top line, what we always want to see is growth here. Now, we like to see 3 to 7% increase year on year. 16.5 billion reported in September 2014. Latest annual accounts, 36 billion. So we do in fact see their top line has more than doubled over the last 10 years. And it is also moving in the right direction. So over the longer term horizon, it is a company that has been growing their top line. How does this compare to their bottom line net income? We want to see a very similar story. And just how their top line has essentially doubled. We also note their bottom line net income has gone from 2.1 billion in 2014 to around 4.12. So positive to note, both top line and bottom line have in fact increased, in fact doubled over the last 10 years. Now also we can see it is looking like the trend is in the right direction. We just want to point out September 2020, we can see here 928 million reported due to COVID, a lot of lockdowns, so they were unable to have the customers walk into the stores and buy their lattes or whatever products they want to purchase. Very quickly, before we look at their earnings, in terms of the health of this company, their total cash versus their total debt, 1.8 billion of cash in September 2014. Their latest quarterly report, 3.1 billion. So their cash position has increased over the longer term. We do see some inconsistencies, but overall they are holding a lot more cash than they did 10 years ago. Doesn't necessarily mean any indications of good or bad, but what we always have to do is compare it to their total debt numerically and directionally. What we can see, their total debt levels are very, very high. In fact, 2.1 billion in 2014. We're now looking at 25.2 billion. So do bear in mind their cash, which has nearly doubled their bottom, or in fact their total debt has in fact increased more than 10 times. So they are sitting on a very large debt, and we will consider this when we do look at essentially their dividend safety and their net debt to EBITDA levels. Now let's jump into their actual earnings. Now we can see the headline reads that their shares were down 12% as they slashed their 2024 forecast amid their same-store stores dragging. Now, not great at all. We can in fact see here they've reported weaker than expected quarterly earnings as well as revenue, and again they do mention that this is a surprise decline in same-store sales. Now, a lot of people on this channel do talk about their local Starbucks, and they do say that when they do go in or when they pass by, it is quite empty, and we can in fact see that this has now been produced in their results as well. We are seeing something very similar with shrinking same-store sales and falling traffic. Now, how bad were these results? When we look at just the headlines, we see the earnings per share, 68 cents was what they reported. The market was anticipating 79 cents, so incredibly poor, as we can see here. And on top of that, their revenue, 8.56 billion, a very large miss. 9.13 billion was expected, so not great at all, so something just to consider. And we do note also their bottom line, their net income per share, 68 cents per share was what they reported, whereas last year it was 79 cents. So not only have they essentially decreased versus analyst targets, but also from a year ago it is lower, and we can also see their net sales as a percentage is lower by 2%. So not good at all. We are going to do a deeper dive into their investor presentation deck, but we can see they have lowered down their targets for revenue growth for the full year to be low single digits, whereas before they had forecasted around 7 to 10%. So not great at all. A lot of people will be looking at the share price now saying it is a great opportunity. The market has overreacted, but we need to continue to do our deep dive to understand whether or not this is the case, as well as look at the valuation. Now, this is their earnings data over the last 4 quarters. We have the quarter from yesterday, and we can see a very, very similar trend. In the last 2 quarters, we have essentially the grey or the black showing us here what essentially markets were looking at, and in the blue, we can see the actual. So, in fact, the last 2 quarters, we note they did beat, but when we look at quarter 1 of 2024, so the last results, they in fact missed on the earnings per share by 4 cents, and we can also see they have missed again by 12 cents in this latest quarter. So not great. One thing that we will look at their results and what management is saying is that they do believe this trend of lower performance will continue over the next few quarters. So do bear this in mind when we are looking at our valuation and your overall investment thesis. Now, in terms of the valuation grade, they do get a D-. I just want to point out that currently, essentially, their forward P sits around 19.5, so this numbers haven't updated yet. But even so, when we do look at it on a non-GAAP basis, the market is trading much lower at 14.95, and when we look at it on a GAAP basis, 15.69 as well. So Starbucks, even after the massive drop that sits at 19.5 on a forward basis, the market, the industry leaders, the average is still a lot lower at 15.69. A lot of investors will say that Starbucks does deserve to be trading at a premium, but again, every investor has their own thesis, and we can see just across the board the different valuation methods, they are still a lot higher than the industry, hence why they do get the D grade. Now, I do want to point out that when we look at their growth, it is a B, so it is a lot better when we compare it to the valuation score. Year-on-year growth, double-digit 11.46, but the median sits a lot lower at 3.29, and on a forward basis for the full year, they have now lowered their forecast to be low single digits, so something to consider. Yes, year-on-year it was looking good, and this forward, whilst they were anticipating higher single digits, they now are anticipating more in line with the sector median of 3.74. One thing that I would point out is even though over the longer term we can see the anticipation is there to be double-digit growth to the earnings per share over the next 5 years of 15.28, not only is the sector median sitting lower at 11.6, but given these results, given these trends over the last 2 quarters, I do believe this should be in fact lower. So in fact, when we do take a look at the updated growth grade, I would say this should be sitting at around a C and not a B. So not great on the valuation, not great on the growth grade. How about the profitability? Well, we do see much better. They get a rating of A+, so the highest score obtainable. Gross profit margin, now they are lower considering how much they charge for their coffees and their refreshments and other products. Surprising to note that the gross profit margin is not just low at 28%, but also lower than the sector median. When we look at the bottom line, however, it is sitting higher at 11.7% when we note that the industry leaders on average sit around 4.51. So it is positive to note that they have good profitability, even though when we took a look at their growth and valuation, it does leave a lot to be desired for. Now, when we take a look at insider ownership, we do see it is just under 2%. We see 3 instances of insider selling of around 1.53 million. Now, we in fact note here Q2, 300,000 worth of insider selling, again around a similar amount in Q1 and a little bit more in Q4. So over the last 3 quarters, we do see insiders have been selling, and in fact, notably the CEO himself did sell on the 15th of April over 3,000 shares for just under $300,000, and we can see the Vice President Sarah Kay did sell a trivial amount for $22,000. Now, I wouldn't say this is necessarily a bearish signal. The information is there. Add it into your investment thesis if you want to consider. I do prefer to see buying as more of an indicator, a bullish signal. Bearish signal on the selling, again, if you believe that, but ultimately we don't know why the insiders sell, what the reasons could be, personal, financial, or anything else. Institutional ownership, it does sit just over 72%. We see $8 billion worth of sales by the institutions over the last 12 months. We see a lot more buying over the same period, $22 billion, and in fact in Q1 we also see more buying than selling, and the same is for Q4. So not just over the last 12 months, but also over the more recent quarters, institutions are buying more shares of SBUX, and it will be interesting when we have the data for Q2 to see after this massive drop whether or not institutions continue to add their investments into this company. Now, just to let you know, we have released our latest free weekly article as well as others. If you want to gain instant access, do click on the pinned comment below. And this one here, we just want to point out how to find undervalued stocks. We look at all the websites we use when we look to invest and cover on the channel. A lot of people always request that, so the article is literally right here that you can click on straight away, all completely free. Now, before we jump into the dividend safety, let's take a look at their own investor slide, and we can see a few notable things. The first one, their revenue is down 1% year on year. Not great for a company like SBUX that you would like to see increasing on their top line, especially over the longer term, over the last year. Now, comparative sales, essentially, global, they are down -4%. When we look US specific, down 3%. And in terms of China, we see -11%, as that is specifically there. International overall, -6%. So the sales has actually decreased significantly from China, which was meant to be one of their growth drivers over the next few years. So a little bit of a letdown when analyzing that. When we look at their operating margin, remember what we always discuss on the channel. We want to see operational efficiency. We want to see increasing top line, increasing operating margin. So unfortunately, we have to say that not only did their top line reduce year on year, but also their operating margin. Earnings per share as well, down 7% year on year. However, their stores increasing is up 6%. And let's be honest, if you aren't getting the footfall, if you aren't increasing those margins, if you aren't increasing the revenue, it doesn't matter how many stores you have. They could have 25 million stores, but if people aren't getting in there to buy their overpriced drinks, then unfortunately the global store count isn't something that we should really take into account. Now, a few other things that we want to look at, and very importantly, I always like to draw your attention to the full year guidance. Now, global low single digit decline to flat, US low single digit decline to flat, and we can see here China single digit decline. So remember, as I mentioned earlier, they're not anticipating a massive turnaround in the shorter term, so do factor that in. We will look at that in detail when we look at the margin of safety as well as the valuation. New store growth, so they are anticipating growth across their global US as well as China, but as I mentioned, and remember, you can open up as many stores as you want. If you're not getting the footfall, if people are not coming, it is something to consider. So as we can see here, then in conclusion, global revenue low single digits, operating margin flat, expenditure $3 billion, I'd imagine, for those new stores, and we can see their full year earnings per share on both a GAAP basis as well as non-GAAP, flat to low single digits. So what I quite like to do is look at the dividend safety score. Firstly, 67, it does look to be safe. What we do know, notably, over 3% now yield for this company, and we can see the market cap does sit at 100 billion. It is a mega cap company. Now, their dividend safety score was reaffirmed on February 14. As we can see, a dividend cut is unlikely. It will be interesting to see after their earnings if this will be revisited and it will come down slightly lower. Last recession, how did they perform? Well, there was no dividend, so no comparative data. They had -6% sales, slightly above the average. Remember, the S&P during the same time, -12. Recession return, very poor, -69, with the S&P itself -55. But it does make sense in an inflationary environment, in a recession. customers will not be looking to spend $10, $12 on a latte. Now, in terms of dividend growth, while very strong, we love to see this across our dividend companies. 7.5% in September, so high single digit, double digit over the last 10 years, double digit strong, in fact, over the last 10 years. Just something to point out, it will be questionable whether we get an increase in the high single digits given their poor performance and the indication the poor performance will continue. They have been increasing those dividends for the last 13 years as well. Now, dividend yield theory, for those that are new, it states the company is undervalued when the current yield sits above the 5-year average. 3.03 versus 2.04. We have a massive sign of undervaluation purely on the yield, and we can see another massive undervaluation signal on the forward P, 19.2, lower than the 5-year rolling. Do bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end. We do note that it is much higher than the consumer discretionary sector P of 13.5. Now, in terms of the free cash flow, as always, remember we do draw your attention to the free cash flow earnings, not only susceptible to manipulation by management through accounting, but it's harder to spot those dividend cuts. Below 60%, my blanket rule, below 50% for the restaurants if you want to be industry specific. And we always have these targets because it gives us faith that management can offer double-digit increases we love to see. Now, 67% was the full year 2023, expected to be lower in 2024 at 61%. So right now, the dividend looks completely fine at that level. But just bear in mind, if the essential quarterly earnings does start to deteriorate, there may be an indication that the dividend growth won't be as high as we have historically seen. Always invest in companies where free cash flow is increasing. Always, that is something that is very, very imperative to investing overall. We can see it has increased over the longer term. It is looking essentially like it is very inconsistent. Positive to note that increase expected into the full year of FY24. Sales growth, this is what we love to see. Double-digit growth, especially as a baseline, we want to see steady moderate of 3 to 7%. So the fact that Starbucks every single year, bar 2020, has had some strong growth is a positive sign. But let me bring you back to reality. 2024, they are expecting single-digit increases. So it is a bit of a shame, but guaranteed that is why the share price is taking a massive hammering. Total sales then, just another format of what we saw earlier. Shares outstanding, we love it when companies do those share buybacks, returning that excess cash. What we have noted though, yes, it does decrease, which is very strong, but over the last few years, it has been a lot slower in terms of those share buybacks. Given the very high debt levels that we discussed earlier, it doesn't look like they will be continuing that at a very rapid rate anytime soon. However, that is just our opinion. ROIC, return on invested capital, 10% or more, 12% or more if you want to be industry specific, just giving us faith that management are able to effectively allocate their capital. Last 3 years looking very strong, although we have noted it has been in the 40s over the longer term. As long as it continues in the high 20s, in the 30s, then it does make it a very attractive proposition to potential investors. Operating margin, now this was a bit of a red flag indicator when we were looking at their earnings. Not only is their revenue dropping, but also their operating margin. We want it to be high or at a minimum around the 16 to 17%. We can see it has straddled around that over the longer term, but definitely one to keep an eye on, especially moving forwards, and we will report on their earnings over the next quarter as well. Free cash flow margin, inconsistent, but overall it does look healthy. Last 3 years looking very strong, trailing 12 months also looking healthy. This finally brings us on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 3.5 for restaurants. Remember, each one of these numbers are the number of years it would take Starbucks to pay off all of their debt net of cash on hand. It doesn't just correlate to balance sheet strength, but also their dividend safety. 2.06 in FY23, it is healthy, it is below 3.5. 1.95 in 2024, also moving in the right direction. As long as it stays significantly below 3.5, there is no worry about the dividend, with the free cash flow payout around the 60% as well. All is looking healthy with respect to that, and it is starting to look attractive at the 3% yield level. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's jump into the first valuation model, the multiples valuation, where we have the P multiple of companies in a similar sector and size. The average P is around 34 as we can see. With the EPS, we do get an intrinsic value of around $127 with a massive undervaluation signal. But bear in mind, we're not looking at any of these models in isolation. We then move on to the dividend discount model. We can see the yearly dividends, average growth rate looking very nice. Now we have gone a lot, in fact we would say very conservative at 5.5, lowering our previous estimates. Given essentially these earnings and the future, we do anticipate it won't be as high as maybe we would have liked. Nonetheless, we still get that undervaluation signal, $96 based on this model. We then move on to the DCF model, the free cash flow year on year. Average growth has been very strong for Starbucks. In previous models, we have gone from around 12%, so we have lowered it to 11%. We have lowered it based on their earnings just now. With the discount rate at 8%, we do get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see an undervaluation signal with the intrinsic value at 97. Now, just to let you know, if you grab a copy of this model in the pinned comments below, you can play around with these numbers, whether it's Starbucks or others on your watch list or in your portfolio. For example, if you believe that we should have gone back to the 12%, we can see the intrinsic value goes up to 105, or if you do believe it should be lower at 10%, you can see it goes further down to 89. So we are going to carry through the initial 11%, and the intrinsic value in today's episode is just the average of these three models, and it does arrive at $107. Now, when we take a look essentially at the current price, we always use a margin of safety, very important. We start off with 10% in today's episode, and we execute on that if it meets three golden criteria. So a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price to get to what the MOS level currently would be, and we can see in today's episode it is sitting around a 30% MOS level, but do bear in mind the earnings is expected to deteriorate over the next few quarters, and the sales for the full year is expected to be in the low single digits. So depending on what MOS level you are comfortable with, that will determine whether or not it is a buy for you at these prices. In terms of Wall Street and their forecast, well, they still believe overall that it is a buy around $103. As we saw at the beginning of the episode, both buys from Wall Street and Seeking Alpha, they see upside of 39%. But as always, let us know your thoughts in the comments below, whether or not Starbucks is one you're adding to, whether it's one you're considering waiting for it to come down lower, or for whatever reason, just the future outlook, it isn't one you want to dabble in right now. We can also take a very quick look at how its performance has been versus its competitors over the longer term. Now, when we take a look at others like Chipotle, like DoorDash, like Compass and Yum Brands, we can in fact see that over the last year, it is down the worst performing negative 33%. When we extend it over the last 5 years, again, not great at all in the bottom half of its competitors, only up 7%, and that is including reinvesting those dividends. And if you look over the last 10 years, what we can see is it is essentially the third best, up 157 cents. So not bad at all, but that is over a longer term. And when you do look at just in the more recent period, we can see that it has been hammered down 30% in the 3-year span. But as always, do let us know your thoughts in the comments below. Is Starbucks one you're looking to add, or maybe it is one for today you're deciding to pass? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts below, and as always, we'll see you all on the next one.